Main Street Asset Management CIO Aaron Gibbs and Sarge Guilfoyle. Of course, Sarge, great to see you. Give me your thought at this very moment about, the retailers. Why wouldn't Amazon, after an $11.3 billion Cyber Monday, be doing better than it is?
Well, let's put it in perspective. Cyber Monday was up 8.4% from last year. Inflation is up 7.7% from last year. So, yeah, there's progress, but it's not tremendous progress. It's not like this record is so fantastic. And Black Friday, just a few days ago, the online spending was only up 2.6% from last year. So, in real terms, it actually contracted from a year ago when you take inflation into account. So, yeah, the holiday season, holiday shopping season is off to a pretty decent online start, but it's not great.
I would say so. Aaron, let's broaden the discussion here. We've got Amazon down $1.61. That I'm much less concerned about. I think it's interesting to look at the overall picture and say, why are investors so jittery at this point?
A lot of things. One, I think certainly the Chinese protest is obviously a big thing that we're weighing on. We know that we're facing a global recession, and if China is not a strong participant in that growth and coming out of the recession, it's going to be much harder for the U.S. to carry the entire world, right? Because we know it's not going to come from Europe.
So what does an investor do?
So one of the things that we're looking at, obviously, is what's going to happen next year. And that's part of the reason that some of these retailers are down, because their earnings are being cut so hard, their profit margins, especially when the retailers are facing these inflationary pressures too. And so you've got to look at where are you still going to be able to make money, have really good profits next year? Where is the consumer still willing to spend their money? And a lot of that so far is being forecast in hotels, resorts, restaurants, basically entertainment, not stuff.
Which brings me to the transports. Sarge, did you see the transports today? While most everything is down, although the Russell's seeing a little bit of a gain here, the transports are up about 1.5%. So we're seeing some real strength there, whether that is the railroads, the choo-choos that are shipping this stuff, or the airlines, or these companies that move humans, because that's what people want to do. What do you make of that?
Well, I think a lot of that has to do with the railroads right now. Going into this recession that we're talking about next year, which I believe we're back in recession by the late first quarter, early second quarter. All right, that's when you're going to see earnings stall just as well. And I believe that whole travel entertainment play might just die out right then. Disinflation will become a reality. Everything next year from that point on is really going to depend on what the Fed's level of sensitivity to a slow growth or no growth environment, in addition, while inflation is not reversing itself but slowing down to a great degree. We're going to need to see the Fed go in a different direction much faster than they're probably willing to do that time, or we'll have a deep recession.
Look at these hotels and resorts. Everybody's moving higher. Hyatt up 3.33%. Not a bad move. So, Aaron.
Yeah, I'll tell you, that's where the money's going.
I'll tell you, it is a confusing. And Sarge just said, if people are worried about what's going on in the economy and the Federal Reserve and the economy slowing, I'm still trying to wrap my mind around how you and Sarge could see that the economy is looking at a recession when people just spent $11.3 billion shopping.
Because ultimately, when you do that inflation adjusted, it's really not that great. In fact, in many cases, it's actually a contraction if you're taking 9% inflation into account. Mm-hmm. And so even though we're hitting these record numbers, they should be record because we're at 9% record inflation. So I think particularly as an investor, you're really always looking 12 months ahead. So what happened last weekend isn't why you're going to buy a stock today or tomorrow. And that's what we've got to look at, is what are consumers still going to be willing to spend their money on, even if we hit a recession, even if this inflation keeps going for another 9 months.
Sarge, we know that the Federal Reserve Chief Jay Powell is speaking tomorrow. What does he need to say to turn these markets green?
Well, he's not going to care if he turns these markets green. He's probably kind of happy that we sold off for a couple of days
actually, now that I think of it.
Yeah, I think that if he does turn the markets red again tomorrow, I think that's a buying opportunity. The October 13th reversal in trend that we saw is still intact. It's been confirmed and reconfirmed. This S&P 500 is still above its 21-day and its 50-day moving average. The Nasdaq's given up the 21-day today, but the SOX, the Philly Semiconductor Index, is still above both of those lines, and that's the driver of the Nasdaq. So as far as I'm concerned, technically nothing is broken. You're clear for the rest of the year in Sarge's world. Maybe not next year, but you got another 4 weeks to go.
Aaron, as selective as you have been, what is the one sector that you think is really now down at a fairer valuation?
So one of them being the hotel and resorts. Even with these down days, Booking.com is one of my favorites within the area, online, obviously hotels. But I think you've really got to avoid, it's partially just about avoiding your high growth, very expensive stocks, because when we're looking at valuations and we're looking at earnings coming down next year, those are still the most vulnerable and they could be down. And you see that in the NASDAQ numbers versus the Dow. So I think even if you just avoid that, you're going to be okay.
Aaron, Sarge, what a lovely day. We're still waiting for some green on the screen aside from hotels and resorts. Dow is down about 34 points and we still have the NASDAQ down 71 and the S&P down 9. Okay, thank you both.